The chart looked perfect. Bitcoin floating above 120,000, headlines glowing with the words new all-time high. The talking heads smiled, the influencers tweeted victory laps, and the crowd believed this time was different. ETFs were here, institutions had arrived, the future was finally digital, unbreakable, and clean. But if you watched the order books, the rhythm was wrong. Every rally looked the same. Fast, vertical, mechanical, the kind of move that doesn't come from conviction but from leverage. Each candle up was borrowed time. The setup for this crash didn't start with panic, it started with comfort. The illusion that flows would never stop. Every morning, billions in ETF inflows printed across the terminals. Neat, professional, reassuring. Bitcoin became an index product. Volatility shrank. Funding stayed positive. Traders called it a new era. What they really meant was, we've forgotten what risk feels like. When markets are quiet, they don't heal. They tighten, energy builds, and in August, that tension snapped. It began with a policy ripple, not a crypto headline, a tariff escalation, a trade statement, a simple line from a podium. But the timing was perfect. The market was maxed out on leverage. ETFs had pulled all the passive demand forward, and liquidity was shallow. It only took one push for the dominoes to fall. Within hours, the Bitcoin tape flipped from strength to chaos. From 125k highs, it sliced through 119, then 114, and briefly touched below 110. On offshore venues, the wicks went even deeper. Ethereum, Solana, and the rest followed in synchronized collapse. Not because of unique fundamentals, but because leverage made them move as one. This wasn't a natural correction, it was a liquidation cascade written into the structure of the system. When everything is built on borrowed margin, price stops being a vote. It becomes an algorithmic chain reaction. Here's how it unfolded behind the curtain. Large wallets started unloading into the strength days before the headline hit. You could see it in on-chain flows. Old coins moving, smart money rotating into stables. Then came the futures bleed. Funding flipped negative for the first time in weeks, and open interest spiked just before the rug pull. A perfect setup, maximum leverage, minimum liquidity, and a catalyst everyone underestimated. The real trap was the illusion of safety through ETFs. On the way up, they create liquidity. On the way down, they freeze. They settle at the close. Liquidations settle now. When the crash started, ETF inflows didn't stop it. They simply lagged the disaster. Retail believed the presence of big money would stabilize the market. In truth, big money doesn't catch knives. It waits for blood to dry. What made this drop historic wasn't the percentage move. It was the speed. In less than 12 hours, more than 12 billion in long positions were liquidated. Some exchanges hit record single-hour volumes. It looked like panic, but it was automation. Thousands of positions hitting margin calls simultaneously, feeding each other until the books were empty. If you zoom out, it's almost poetic. A decade after Bitcoin's birth as rebellion against financial manipulation, the crypto market finally matured, only to fall for the same structural trap that broke traditional finance, leverage disguised as liquidity. The ETF era turned Bitcoin into just another risk asset, a shiny piece in the macro puzzle. The crowd wanted Wall Street legitimacy. They got Wall Street consequences. And the worst part? Most of this was visible. The signals were there. Excessive funding, compressed volatility, declining volume, and a slow bleed of realized profit. It's always the same cycle. Euphoria, complacency, cascade. What changes is how cleanly the system hides it behind new narratives. This time, the narrative was digital gold. But gold doesn't drop 15% in a day because of a press conference. Bitcoin did because the structure was brittle, built on borrowed conviction. Now the question isn't why did it happen. The question is who made sure it happened exactly like this. Because no market event this precise is purely organic. The chain reaction was inevitable, yes, but someone always pulls the trigger. The thin overnight liquidity, the synchronized selling across venues, the visible clusters of stops around 120k and 115k, these are not coincidences. They're hunting grounds. The modern crypto market is an open jungle of algorithms. Big funds don't manipulate by emotion, they manipulate by math. They see where the leverage hides, calculate where pain begins, and push just enough volume to start the avalanche. Once the cascade begins, they step aside and let liquidation do the rest. In that sense, the crash wasn't chaos, it was design. And here's the cold truth. Every cycle has this moment. The engineered flush is not about destroying Bitcoin, it's about resetting the board, clearing weak hands, resetting funding, and building a fresh liquidity base for the next run. The crowd screams manipulation, but the real players call it rebalancing. From their perspective, it's not cruelty, it's efficiency. Markets can't rise forever on unhedged optimism. A purge is required to feed the next parabola. The difference is that this time the purge was faster, deeper, and more global. ETFs, derivatives, and 24/7 crypto markets turned corrections into synchronized global events. In the old world, a crash meant market hours and circuit breakers. In crypto, there's no close, no break, no mercy. Liquidation doesn't sleep, and yet behind all the red candles and panic tweets, something else shifted, something structural. The illusion of a safe institutional market cracked. Retail saw, maybe for the first time, that institutions institutions don't protect you. They protect themselves. When ETF issuers talk about exposure, they mean capital rotation, not conviction. When they speak about long-term adoption, they're referring to fee stability, not your financial freedom. This was never a revolution. It was an absorption. The wild, unregulated experiment called crypto was finally pulled into the same gravity well as everything else. Policy, liquidity, and macro. And that's where the real story begins. Because once you strip away the panic, what remains is a brutal, elegant equation. Who controls the flow, controls the market. And right now, the flow isn't driven by conviction. It's driven by policy. Every major drawdown follows the same invisible script. It's not about bad news or sudden panic. It's about positioning. When everyone leans the same way, the market doesn't need a reason to reverse. It just needs an excuse. In the weeks before the crash, funding rates stayed positive for too long. That's the first red flag. It means traders were paying to stay long, convinced the next leg higher was guaranteed. Then came the ETF flows, billions in steady inflows that created the illusion of permanent demand. But flows aren't sentiment, they're inertia. And inertia always dies at the first shock. What made this setup lethal was the combination of ETF mechanics and leveraged speculation. Traditional ETFs rebalance at the close. They don't absorb panic mid-session. So when volatility hits intraday, there's no stabilizing bid, only delayed reaction. In crypto, where everything trades non-stop, that delay becomes a weapon. The moment forced sellers hit the tape, ETF inflows can't respond. The market free falls in real time, while institutional products sit idle, waiting for their next batch window. That's how liquidity deserts form. The book goes thin, stops trigger, and liquidation bots take over. Each cascade pushes price lower, triggering the next batch of forced sells. It's not emotional, it's mechanical. But someone always profits from that mechanic. When you know where the leverage hides, you don't fight the cascade. You start it. Large players monitor aggregated liquidation levels across exchanges. They know where retail stops cluster. They can estimate the density of liquidations between key price zones. Then they test the market with bursts of volume, not to move price organically, but to flush it. Once a critical level breaks, the chain reaction does the rest. This isn't theory, it's visible on-chain. The sell volume spikes seconds before liquidation walls collapse. You can almost hear the machine breathing. Liquidity vacuum, forced closure, artificial recovery. That's the rhythm of a market controlled by capital with better data and no emotion. When small traders call it manipulation, they're half right. It's not emotional manipulation, it's structural. The market isn't tricking you. Is using you, and the tool of choice this cycle was leverage disguised as legitimacy. Spot ETFs brought a wave of institutional interest, but they also brought Wall Street microstructure into crypto. Arbitrage desks now bridge futures, spot, and ETF baskets in milliseconds. They don't care about Bitcoin's ideals, they care about spread capture. When volatility spikes, they hedge by shorting futures, pulling liquidity from the same venues where retail trades. So in moments of stress, the very institutions that were stabilizing the market become the ones amplifying the downside. ETF inflows look bullish on paper, but they also create liquidity imbalances because every new share minted by an ETF requires market makers to source Bitcoin from spot exchanges. That works perfectly in calm conditions. In a storm, it breaks, market makers hesitate, spreads widen, and the ETF arbitrage loop slows down. That's when you get dislocation. ETF prices trading below net asset value, signaling panic in the pipes. It's ironic. The same structure built to make crypto suffer actually made it more fragile. Meanwhile, retail traders keep playing by an outdated rulebook. They think charts reflect psychology. They don't. They reflect liquidity access. When the biggest players can see every open interest cluster, every funding imbalance, every liquidation map, psychology becomes obsolete. What matters is who controls the data flow. The current market isn't a battlefield, it's an ecosystem. Algorithms hunt inefficiencies and humans are the inefficiency. That's why most traders lose money even when they're right. They see the direction, but they underestimate the path. The path is engineered. Before price goes where it's supposed to go, it first visits the level where it hurts the most people. In this cycle, that level was 110K. A perfect magnet. Round, psychological, visible, every stop, every liquidation, every over-leveraged long congregated there, so the market had to go there. It's not conspiracy, it's math. After the cascade, social media filled with the same script. Market manipulation, whale games, liquidation hunt. The irony, the whales didn't need to hunt anyone. The crowd told them where to aim. And while everyone was staring at charts, the macro players were already trading a different layer. Dollar liquidity. The same policy moves that hit equities hit crypto harder. When dollar funding tightens, high beta assets bleed first. Crypto just bleeds faster. This is where the narrative turns inside out. Everyone thought the bull run was driven by mass adoption. It wasn't. It was driven by dollar liquidity. Just like every other risk asset. When money is cheap and policy is loose, Bitcoin becomes a high-octane mirror of the Fed's balance sheet. When policy tightens, the mirror cracks. That's why every crypto winter starts with macro, not code. Look back at history. March 2020, global liquidity crisis. May 2021, China crackdown meets overheated leverage. November 2022, host FTX next liquidity vacuum. Every time the headline is local, but the real trigger is global liquidity. This time it was policy shock wrapped in tariff news. That's the part most retail traders miss. They trade coins, institutions trade liquidity. And when liquidity dries up, the narrative shifts overnight from digital gold to high beta tech. Bitcoin's correlations flip back toward equities, altcoins behave like small caps, and everything falls together. It's not just about the price drop, it's about synchronization. That's what makes these events systemic. The same quant systems managing equity exposure are also managing crypto allocations. When risk-off triggers, the sell signal travels across asset classes in seconds. Bitcoin, Ethereum, tech stocks, and high beta proxies all exit at once. The deeper you look, the clearer it becomes. This wasn't a market accident. It was a liquidity rotation disguised as a crash. Some call it manipulation, others call it rebalancing, but the outcome is the same. Capital gets transferred from the impatient to the prepared. This cycle's purge was efficient, global, and fast. A generation of traders learned the same lesson again. Leverage is not a strategy, it's a timer. And yet, behind the destruction lies opportunity, because when volatility explodes and fear dominates, the structure resets, funding clears, leverage evaporates, true accumulation begins quietly, long before the headlines flip bullish again. The smart players don't try to predict the bottom, they build it by absorbing forced sellers at pre-written levels. They don't need hope, they have liquidity. This is how the market renews itself, through engineered violence. So the real question isn't who caused the crash, it's who's rebuilding now that everyone else is scared to click buy. When the smoke clears, markets don't heal through optimism, they heal through absence. Absence of leverage, absence of noise, absence of belief. The crash isn't just a price reset, it's a filtration process. It removes the weak hands, the short-term thinkers, and the illusions built on borrowed conviction. What remains is signal and capital that understands pain as part of the design. Every cycle ends the same way. Silence, no more hype, no more promises, just the charts breathing again, quietly, like an animal that survived the hunt. That silence is where smart money starts to move. Slow, methodical, invisible. It's always the same pattern. Retail watches headlines, institutions watch flows. The former waits for permission, the latter creates it. When the crowd finally believes it's safe again, the real opportunity is already gone. This is the psychology that never changes, the need for certainty in a system built on uncertainty. That's why the majority can't win in markets. They search for emotional comfort, not asymmetry. They want validation, not truth, but the truth is simple. The market rewards discomfort. It pays those who act when conviction costs something. When everyone's afraid to buy, the system discounts the future. When everyone's desperate to sell, it prices in extinction. That's when the real traders, the ones with capital and patience, step in. The recent collapse wasn't chaos, it was calibration. The system purged excess, cleared funding imbalances, and punished hubris. It was cruel, but efficient. If you strip away the emotion, you see the structure. Every liquidation was just forced rebalancing. Every crash was just compression of risk premiums. Markets don't die. They compress, expand, and migrate. The illusion of death is just part of their evolution, and this evolution is accelerating. Crypto no longer exists outside the global system. It is the system. The same liquidity waves that move bonds and tech now move Bitcoin. The same algorithms that price equities now price tokens. The line between crypto and finance is gone. What remains is data with leverage. That's the new meta. Every token, every position, every narrative, it's all a derivative of macro liquidity. You can fight it or you can learn to surf it. But pretending it's about freedom or decentralization is nostalgia. This market matured the hard way. It got institutionalized not through adoption but through control. ETFs didn't legitimize Bitcoin. They domesticated it. They turned volatility into a product, a ticker inside traditional finance. That's the real capture. But there's an irony in that, because by turning crypto into a financial instrument, Wall Street also made it unavoidable. You can't kill Bitcoin now. You can only price it differently. That's the paradox of control. The moment you absorb something, you become dependent on it. So where does this leave us? In a cleaner, colder market. The weak narratives are gone. The easy leverage is gone. What's left is an asset that either redefines its purpose or becomes another speculative cycle. The next phase won't be about hype, it'll be about structure. On-chain liquidity, cross-market integration, AI-driven execution. This is the next frontier. Not memes, not tokens, our infrastructure. And psychologically, it's about adaptation. The traders who survive are the ones who detach emotion from expectation. They treat volatility as language, not threat. They understand that every crash is just the market translating new information into new price. Survival in this game isn't about predicting the next move. It's about positioning before the next narrative becomes consensus. You don't wait for permission, you position in silence. That's how real capital behaves. Patient, cynical, precise. If you zoom out far enough, you'll notice something strange. Every few years, the same drama repeats, but the players change. The same mistakes, the same greed, the same disbelief when the system corrects itself. History doesn't repeat because of algorithms. It repeats because of people. Humans don't evolve as fast as the markets. That's why markets win. So, what's the lesson? Stop expecting fairness from a system built on asymmetry. Stop trading emotions inside an algorithmic structure. Stop assuming assuming decentralization equals immunity. The market isn't your enemy. It's just not your friend either. It's indifferent, and that's its purity. Every candle, every wick, every liquidation, it's all data in motion. The sooner you detach from narrative and start seeing structure, the sooner you stop being liquidity and start becoming capital. In the end, that's the only real transformation this space offers. From believer to operator, from participant to architect, the crash wasn't a tragedy. It was a reminder that in the world of money, there are no victims, only positions. And the next cycle has already started, quietly, beneath the noise, where conviction has no audience and opportunity hides in discomfort. That's where the next winners are being built.